Hey, welcome back to the Saskatchewan Real Estate Podcast. For anyone who follows the channel, this background looks a little bit different. I'm actually in Serbia at the moment and looking forward to giving you the news about the Bank of Canada today. It is March 12th, and we did get, as expected, another 25 basis point cut. And so this is really great news for anyone with a variable rate mortgage or someone with a home equity line of credit. Things just got a little bit more or a little less expensive for you. So let's dig right into the story. This is directly from the Bank of Canada's website. Bank of Canada reduces policy rate by 25 basis points to 2.3% or 2.75%. So I have a few paragraphs that I wanted to highlight here. And then what I want to do is take you through how this affects a regular borrower and then just walk you through the upcoming renewals, whether it be in 2025 or 2026, what you should be doing to most effectively manage your mortgage. All right, without further ado, the Bank of Canada today reduced its target overnight rate to 2.75%. A quick note on this, a lot of mortgage clients look at that 2.75% and wonder why their variable rate says, 4.25 or 4%. The key interest rate is what banks will use to influence their prime interest rate. So a lot of banks have a prime interest rate was at 5.7%. In the coming days, they'll reduce that down to 5.45%. The Canadian economy entered 2025 in a solid position with inflation close to the 2% target and robust GDP growth. However, heightened trade tensions and tariffs imposed by the United States will likely slow the pace of economic activity and increase inflationary pressure in Canada. The economic outlook continues to be subject to more than usual uncertainty because of the rapidly evolving policy landscape. What rapidly evolving policy landscape? It is these damn tariffs that Donald Trump keeps talking about. He's in, he's out, he's on, he's off, and it's causing a lot of issues here in Canada for people who are trying to plan their economic certainty here. And I think this rate cut that we're seeing from the Bank of Canada is in large part due to all of this tariff talk. Canada's economy grew by 2.6% in the fourth quarter of 2024, following upwardly revised growth of 2.2% in the third quarter. This growth path is stronger than was expected at that time of the January MPR. Past cuts of interest rates have boosted economic activity, particularly consumption and housing. However, economic growth in the first quarter of 2025 will likely slow as the intensifying trade conflict weighs on the sentiment and activity. Recent surveys suggest a sharp drop in consumer confidence and a slowdown in business spending as companies postpone or cancel investments. This might be Trump's big plan all along, is to actually pull a lot of investment from Canada into the United States. The negative impact of slowing domestic demand has been partially offset by a surge in exports in advance of tariffs being imposed. So they're right. There might be this small bump of a tremendous amount of buying from Canadian importers of American goods, because what happens when the Americans impose their tariffs? Canada's likely going to have some retaliation. That's going to make things more expensive here at home. Quickly touching on inflation, because I think this is an interesting juxtaposition to we have this tariff talk, and I think that's going to be very negative for the economy. But the Bank of Canada also has to watch employment and inflation. I jumped ahead a bit there, so let's quickly touch on employment, and then we'll go through their inflation in this report. So employment growth strengthened in November through January, and the unemployment rate declined to 6.6%. In February, job growth stalled. While past interest rate cuts have boosted demand for labor in recent months, there are warning signs that heightened trade tensions could disrupt the recovery in the jobs market. Meanwhile, wage growth has shown signs of moderation. So this is a major factor that if the job market slows down in Canada, this is extremely negative for the economy, because if people are losing their jobs, they don't have as much money to spend into the economy. Inflation remains close to the 2% target. The temporary suspension of the GST, HST lowered some consumer prices, but January CPI was slightly firmer than expected at 1.9%. Inflation is expected to increase to about 2.5% in March with the end of the tax break. The bank's preferred measure of core inflation remains above 2%, mainly because of the persistence of shelter price inflation. Short-term inflation expectations have risen in light of fears about the impact of tariffs on prices. So this is a really key component as well here. The Bank of Canada has not achieved depreciation on inflation. We're not seeing any negative numbers yet, meaning things are getting more affordable. We are still seeing month over month, year over year, a steadily increasing inflation. And this is something incredibly careful to watch, because if these numbers start to go up at the same time that we're in an economic slowdown, this is big trouble for Canada, because if we have really high inflation, this could mean high interest rates. And if there's a recession or a depression, there's no tools that the Bank of Canada can use if inflation is out of control. So this kind of wraps up what the Bank of Canada was telling us with this interest rate cut. And what I wanted to do now was run us through a little scenario for how this is going to affect folks who currently have a variable rate mortgage, what it means for your month-to-month mortgage amounts here. With the help of ChatGPT, a payment breakdown of the 0.2% rate cut. So for every $100,000 of mortgage with a 25-year amortization, so let's just assume that your interest rate was around 4.25% prior to the cut. That puts your monthly payment around $541.74. Post-rate cut, we're looking at an interest rate of around 4%. And so this means the monthly payment drops to $527.84, an approximate monthly savings of $13.90. So no, not a tremendous amount of money, but this compounds if you had a really high mortgage. And we've also had successive cuts here. So steadily, the variable rate is getting more and more affordable. And that brings me to kind of the conclusion of the video. Let's chat about what's coming up here in 2025 and 2026. A tremendous amount of Canadians are renewing their mortgages. And now is the perfect opportunity to do some cash flow optimization. And what I mean by that is lots of folks have increased the amount that they've held on lines of credit and credit cards. And if your renewal is coming up, there's a really great opportunity to potentially save a couple hundred up to thousands of dollars per month, because if we can wrap these high interest debts into your mortgage, the interest cost on the mortgage is generally much lower than what you're paying on these high interest debts. So the mortgage renewal is a great opportunity to have a mortgage broker who has an understanding of how to put these numbers together to give you a much better cash flow position. There's also lots of different strategies that I can help implement for you, especially if you own a rental property. Rental cash stemming is quickly becoming one of my favorite strategies to share with clients and realtors, and it's incredibly powerful. So if you have any questions in regards to an upcoming renewal, specialty strategies, or how these interest rate cuts affect you, I have my booking link in the description of this video, and I'd be happy to walk you through any questions, or if there's anything that you needed to bounce off me, I'd be happy to do so. Hope everyone is staying safe, happy, and healthy. Until next week, bye for now.